What if the most powerful weapon in the world isn't a missile? What if it's a currency? Right now, almost every major trade deal on Earth touches one thing: the US dollar. Oil contracts, semiconductor purchases, aircraft sales, shipping insurance, sovereign debt. Even countries that dislike Washington still price their most critical transactions in dollars. Why? Because the dollar isn't just money, it's infrastructure. It's the plumbing of the global economy. But infrastructure can be rerouted, quietly, gradually, without headlines, and that's where the real story begins. For decades, the dollar has been the undisputed reserve currency of the world. Central banks hold it, corporations invoice in it, governments borrow in it. During crisis, capital doesn't flee the dollar, it runs toward it. That kind of trust creates enormous power, because when your currency is the backbone of global trade, you don't just participate in the system, you influence it. Sanctions become more effective, debt becomes easier to finance, military spending becomes cheaper to sustain, and geopolitical leverage multiplies. But here's the uncomfortable question. What happens when other major powers decide that leverage is too dangerous? What happens when rivals begin building alternatives, not to destroy the dollar overnight, but to reduce their dependence on it? In this video, Strategic Briefing will explain why the real geopolitical rivalry of the 21st century is not only about territory or military strength, it's about monetary dominance, and why the quiet moves happening right now may matter more than most Americans realize. China has been increasing trade settlement in yuan. Russia shifted energy transactions away from dollars after sanctions. BRICS nations are openly discussing alternative payment systems. Major oil producers have begun accepting non-dollar currencies in select deals. None of these actions collapse the dollar tomorrow. That's not the goal. The goal is optionality. Because if you reduce reliance on the dollar, you reduce exposure to US pressure. And that's where the hidden war begins. Not with headlines, but with transactions. Not with speeches, but with settlement agreements. Not with explosions, but with balance sheets. Reserve currencies don't usually collapse in dramatic fashion. They erode. The British pound once dominated global trade. It didn't disappear overnight. It gradually lost ground as financial gravity shifted. The question is not whether the dollar will fall tomorrow. The question is whether geopolitical rivals are slowly redesigning the system beneath it. And if they are, what does that mean for American power? To understand why this matters, you have to understand how the dollar actually exerts power. It's not magic, it's mechanics. When global trade is priced in dollars, countries need dollar reserves. To get those reserves, they hold US Treasury bonds. That demand keeps US borrowing costs lower than they would otherwise be. Lower borrowing costs mean Washington can finance deficits more easily. It means the US can sustain military spending at scale. It means during crisis, the Federal Reserve can inject liquidity into global markets, and the world listens. That is monetary leverage. But leverage only works as long as others accept the system. And in recent years, the system has been used more aggressively. Sanctions have frozen foreign reserves. Banks have been cut off from SWIFT. Assets have been blocked. Access to dollar liquidity has been restricted. From Washington's perspective, this is strategic enforcement. From rival powers' perspective, it's a vulnerability. Because if your reserves can be frozen, are they truly yours? This is where geopolitical rivalry becomes structural. China has spent years building alternative settlement systems. The Cross-Border Interbank Payment System, CIPS, allows yuan transactions outside of traditional Western networks. Russia developed its own financial messaging system after sanctions. Energy trade between certain countries is increasingly denominated in non-dollar currencies. These systems are not yet dominant, but they don't need to be. They only need to grow enough to reduce dependency. Think of it like this. If you rely on one financial highway, the country controlling that highway has influence over you. But if you build parallel roads, that influence weakens, slowly, gradually, without dramatic headlines. There's another layer. Central banks have been increasing gold purchases at the fastest pace in decades. Why? Gold is not controlled by any government. It carries no sanction risk. It cannot be frozen by foreign policy decisions. Gold accumulation is not anti-American. It is pro-insurance, and insurance signals uncertainty. Now add one more variable. trade fragmentation. If global supply chains begin reorganizing into regional blocs, if trade increasingly occurs within aligned political camps, if energy contracts diversify currency exposure, the gravitational pull of the dollar may weaken at the margins. Not collapse, not disappear, but weaken. And in monetary systems, marginal shifts compound. Here's the part most people overlook. The dollar's strength is not just economic, it is psychological. It is based on trust that the United States will remain politically stable, institutionally reliable, financially disciplined. But trust is not permanent. It is continuously assessed, continuously priced, continuously questioned. If foreign governments begin calculating that reliance on the dollar carries geopolitical risk, they don't need to abandon it entirely. They only need to hedge. And hedging changes flows. Flows change yields. Yields change borrowing costs. Borrowing costs change fiscal flexibility. And fiscal flexibility underwrites global power. This is not a sudden war. It is a slow, strategic repositioning. And repositioning, if widespread enough, can alter the balance of monetary influence. So the real question isn't whether the dollar is collapsing. It's whether its dominance is being quietly diluted. And dilution, in geopolitics, changes leverage. Now imagine something subtle. Foreign central banks reduce their purchases of US Treasury bonds. Not dramatically, not a sell-off, just slower accumulation. Instead of expanding holdings aggressively, they plateau. Instead of increasing exposure, they diversify modestly. At first, markets barely notice. But Treasury issuance does not slow. The United States continues running fiscal deficits, continues refinancing maturing debt, continues funding military commitments and domestic programs. If external demand softens, domestic buyers must absorb more supply. And if supply rises faster than demand, yields adjust. Higher yields mean higher borrowing costs. Higher borrowing costs ripple outward. Mortgage rates rise. Corporate borrowing tightens. Federal interest payments expand. Now consider this in a geopolitical frame. If interest payments consume a larger share of federal revenue, fiscal flexibility narrows. Defense budgets face trade-offs. Infrastructure spending competes with debt servicing. Crisis response becomes more constrained. The dollar does not collapse, but the margin of maneuver shrinks. Monetary dominance has always allowed the United States to operate with extraordinary flexibility, to project power globally, to finance alliances, to stabilize markets during panic. But that flexibility depends on confidence, and confidence depends on sustained demand. If geopolitical rivals successfully reduce their reliance on the dollar over time, they reduce Washington's leverage over them, and they reduce their own exposure to American financial pressure. This is why the rivalry is quiet, because neither side benefits from panic. China does not want a dollar crash. The United States does not want fragmentation. But both sides are adjusting, hedging, repositioning. The real risk is not dramatic abandonment. It is gradual erosion, gradual shifts in settlement currency, gradual expansion of alternative payment networks, gradual diversification of reserves. Each shift small, but cumulative, and cumulative shifts alter power structures. If enough trade begins settling outside the dollar, if enough reserves diversify into alternative assets, if enough energy contracts are priced differently, the gravitational center of the financial system becomes less singular, less concentrated, less automatic. That does not mean the dollar disappears. It means the world becomes more multipolar, financially. And multipolar systems are less predictable, less stable, more competitive. For Americans, this matters, because reserve currency status is not symbolic. It affects borrowing costs. It affects inflation dynamics. It affects how easily the government can finance spending. It affects how confidently global capital flows into US markets during crisis. If that confidence becomes conditional rather than automatic, financial stability becomes more sensitive. The dollar's dominance was built over decades, through economic strength, through military stability, through deep capital markets, through trust. The hidden war over the dollar is not about destroying it. It is about testing that trust, testing its durability, testing how much leverage it truly provides. So the real question is not whether the dollar collapses tomorrow, it's whether the system is becoming more fragile than it appears. Because when dominance depends on trust, and trust is quietly hedged, power changes, even if headlines don't. This is Strategic Briefing. We explain how global power actually works.